Netflix just absolutely crushed their first quarter earnings. Their audience is massive, and yet their stock completely tanked in after-hours trading.
Yeah, it was a really surprising drop.
Right, like if you are looking at your portfolio right now wondering why on earth your shares dropped on what looks like great news, well, Wall Street expectations are wild. Welcome to the deep dive. Today we are cracking open a leaked Morgan Stanley equity research report, and they're basically telling the market it is just dead wrong.
They really are. The analyst actually titled this report, "Are You Not Entertained?" which sets the mood perfectly. Our mission today is to synthesize exactly why Morgan Stanley is so incredibly bullish right now and why they are taking this aggressive buy-the-dip stance immediately following that sell-off.
So let us start right there with the core conclusion. Netflix beats the revenue expectations, they hit over 16% growth, but the stock dives. Why is there this massive disconnect?
Well, what is fascinating here is how the market consistently misinterprets the timing of price hikes. The dip was primarily caused by, conservative second quarter guidance, and the fact that Netflix did not raise their full year 2026 guidance.
The market just got completely spooked.
Exactly. But Morgan Stanley explicitly says buy the dip. They reiterated an overweight rating and a $115 price target.
Okay, let us unpack this. It feels a bit like coming home with an A- when your parents demanded an A+. You passed with flying colors, but the expectations were just impossible.
That is a perfect way to frame it. Morgan Stanley is basically the rational teacher saying the A+ is still coming. Because when a service raises prices, it takes a solid 2 to 3 months for that to actually ripple through the financials.
Right, you have billing cycles, 30-day notices, all of that.
Yeah, and they are comparing current growth to a quarter last year where they also had a massive price hike. Creates a tough year-over-year comparison. Morgan Stanley sees a classic compounder stock gearing up for a huge second half of 2026.
But wait, calling it a compounder feels generous. I mean, what hard data is holding up this $115 target?
They look at 3 key data points. First is massive free cash flow. They raise guidance by $1.5 billion to $12.5 billion for the year.
And a big chunk of that came from a specific deal, right?
Yeah, a $2.8 billion term fee from Warner Bros. It just proves their deal-making abilities yield massive dividends outside of just subscriptions.
Okay, so the cash is clearly flowing. What is the second data point?
The ad tier explosion. Advertising is scaling incredibly fast. The ad tier now accounts for over 60% of new signups in the 12 countries where it is offered.
Wait, 60%?
Yeah.
That is a total paradigm shift for their business model.
It fundamentally changes their revenue mechanics. But the third data point is really the craziest. Morgan Stanley calls it the room-to-run metric. Despite having over 325 million paid members, Netflix still has less than 5% of global TV viewing share.
Less than 5%. I mean, with an audience approaching 1 billion people globally, how is that even possible?
It is wild, right?
Mm-hmm.
But they reach less than 45% of addressable smart TV households. Morgan Stanley says it is super early. Netflix only captures about 7% of the $670 billion total addressable revenue pie.
So the empty space to grow is massive. But identifying space and conquering it are different things. What is the core driver actually pushing this engine?
It comes down to pricing power, immense engagement, and pushing into new frontiers. With pricing power, churn is actually improving year over year in every region, even with the recent price hikes.
That makes no sense on paper. They charge more money and fewer people leave.
Exactly. It has transitioned into a baseline utility. And for engagement, view hours actually grew in the first quarter, which is huge because they face 17 days of brutal competition from the Winter Olympics.
Oh, wow. To hold your ground against the Olympics is a massive flex. But here's where it gets really interesting to me. The report mentions a push into podcasts and mobile vertical video.
Right, because historically, Netflix dominates the evenings on the couch. But daytime viewing severely under-indexes. By pushing into podcasts, they're capturing an entirely new segment of human attention.
Sneaking into our cars and morning commutes. They want the morning just as much as the night.
Yeah, and at $8.99 in the US, the ad tier acts as this brilliant, accessible entry point, so the funnel of new users never dries up.
Okay, but unchecked growth narratives always make me nervous. If the drivers are working perfectly, what is the core risk here? Where is the danger?
This raises an important question about capital allocation. The core risk they outline is that technology and development expenses just jumped 17%.
17%? Where exactly is all that money going?
They're spending heavily to overhaul the user interface, build out ad infrastructure, and push into gaming. But crucially, this includes heavy investments in generative AI, plus $275 million in deal costs for a company called Interpositive.
So Wall Street sees a tech company throwing hundreds of millions at AI and gets anxious. Is this 17% spike a red flag, or are they just future-proofing the platform?
Morgan Stanley believes they're absolutely future-proofing, but they are watching it closely. Wall Street gets nervous when companies throw money at Gen AI without a clear ROI plan.
Right, nobody wants a money pit.
Exactly. But Morgan Stanley notes Netflix is testing its investment discipline. They are building M&A muscle, but proving they will walk away if the price is not exactly right.
All right, so we covered the data, the core drivers, the spending risk. What is the bottom line investment advice from Morgan Stanley?
The model is super robust. They see EBIT margins expanding by 200 basis points to 31.5% in 2026.
Which is just a staggering amount of extra cash falling straight to the bottom line.
Massive operating leverage. Because of that, they project over 20% EPS growth, and they model roughly $2 billion in share buybacks per quarter for the rest of the year.
Buying back $2 billion of their own stock every single quarter, that is a massive vote of confidence from management. So what does this all mean for the valuation?
Ultimately, Morgan Stanley concludes the stock is attractively priced at roughly 25 times the 2027 estimated EPS.
Which might sound steep if you compare it to legacy media, but for a tech compounder generating this much cash.
Right, for a company with this much pricing power and 95% of the market left to conquer, 25x is effectively on sale compared to its historical averages.
It is a remarkable picture of a business that refuses to sit still, which leaves you with a final thought to mull over today. If Netflix is exploring live sports, dominating podcasting, and launching gaming apps for kids, when do we stop calling this a streaming war? At what point do we realize they're attempting to become a monopolistic ecosystem for all human screen time?
It is a great question.
If there's a screen glowing, they intend to be the ones lighting it up? Hey, if you want to keep staying ahead of the curve, make sure you subscribe to this channel because our next episode will be even more exciting.
And just a quick reminder, this video is for research and analysis purposes only and does not constitute any investment advice.